All right, so I did it. I cleaned up my margin account. I just couldn't handle it anymore. Couldn't handle the stress. I was just tired of waiting, tired of hoping, tired of holding garbage stocks. So I decided to close everything that I don't want to own for a loss, even if it was for a loss. So I've confirmed a lot of losses. Basically, I was thinking that if I was not in these positions right now and I had the cash, would I buy these positions right now? So basically, anything that I wouldn't buy right now if I wasn't already in it, I basically sold, took the money, and I'm going to use it to buy something else that I think is better. Hopefully, that something else will recover faster or at least better than the other position that I was in. For example, I had American Airlines. I bought at 30, it dropped to $10. So now I'm sitting with American Airlines at $10. Now, do I think that American Airlines has a better chance of going from 10 back up to 30? Or should I take that $10, put it in Coca-Cola, for example, or McDonald's, or even the SPY or the Q ETF, and hope that these stocks have a better chance of recovering whatever American Airlines dropped? So because I don't want to be buying American Airlines right now, so I don't want to have a position in American Airlines right now. So I'm selling for a loss, but I'm also buying something else that I would have bought for sure that would have also dropped. So I'm just basically transferring losing positions. Everything's a losing position right now. Whatever you bought, it's a losing position. So I'm just transferring losing positions just because I'm tired of hoping and holding garbage stocks, and just because I can't handle the stress. But I'm definitely still invested on the stock market, just being more picky, only picking quality stocks and ETFs like the SPY, which tracks the S&P 500, which is basically the top 500 stocks. So it's basically investing in the general market. And I'm also investing in the Qs. So if you look at my TFSA, you see that I've got 134 shares of the Qs at an average price of 221, and that's basically the Nasdaq. So it's basically all the big tech companies like Apple, Microsoft, and so on. And then the only other stocks that I would consider buying individually is this list here. So I've created a watch list. I just called it quality, and these are the only stocks that I'm considering buying individually, which is JP Morgan, Walmart, Costco, Microsoft, Apple. IWM is an ETF that tracks the small caps, the Russell 2000 index, so that's also very safe because it's an index. I've got American Express, Visa, MasterCard, Coca-Cola, the SPY ETF that I mentioned earlier, Q ETF that I mentioned earlier, McDonald's, and Facebook. These are the only stocks that I'm touching individually. I'm not touching anything else. They have a track record, proof of innovation, proof of always being able to compete. Basically, I'm going for brands that take care of their customers, because I honestly, sincerely believe that a company that takes care of their customers will always survive. They have the ability to innovate. I'm not in the game of predicting will they always have a market, will there be competition that might take a market share away from them, will their revenues or their future cash flows grow in the future. That's not a prediction I want to make or can make. What I can see though is that they always have a good product, good service, always take care of their customers, have a proven track record of innovating, getting over scandals, getting over bumps and obstacles on the road, and just a business model that makes sense. So for the moment, my strategy right now is in my TFSA, I'm going to be buying Qs and then writing covered calls on it on a weekly basis. These are positions I'm trying to get rid of. I'm going to try to get rid of it this week. I wasn't able to get rid of last week because of volume and liquidity. And basically, as you could see, if I go to my executed and just look up Qs, you could see that I've been selling covered calls on the Qs every week as much as I can. So last week on April 3rd expiration, while the Qs was trading in the 180s, I sold a covered call at 198 and I collected $30. And then March 31st, at a 199 strike, collected $28. So last week alone, I collected $30 and $28 from the Qs while it was trading in the 180s, and my purchase price is $221. So it's below my purchase price, and I'm still able to write a covered call further away from the current market price so that I don't lose my shares at that strike, but still generating money or income from those positions. You could see that the week before, March 27 expiration, $35. March 20th expiration, $35 again. March 13 expiration, $39 again. March 6th expiration, $25. February 28th expiration, $1.20 or $120. February 21st expiration, $125. In my RSP, same thing. I'm going to stick to IWM. I'm basically trying to sell my other positions. I'm gonna keep DFN.to, but I'm probably not gonna buy more of it. But I'm definitely gonna sell Bombardier and L Brands. I sold Novavax, and I'm gonna keep dollar cost averaging on IWM and then selling covered calls on it out of the money on a weekly basis. So you could see IWM. Let me just filter on IWM. You could see that I sold April 3rd expiration, $21. March 31st expiration, $38. March 27th expiration, $30. March 20th expiration, $25. March 13th expiration, $34. So you could see it as a dividend kicker. I always see it that way right now, as a dividend kicker, as long as you sell out of the money covered calls. Hopefully your strike doesn't get in the money. So hopefully the stock doesn't surpass the strike that you're selling the call option at. So when I'm selling at 118, I think IWM was trading at 109. So I'm hoping that it in 1 week, it doesn't go from 109 to 118. And actually, I'm noticing that I could have gone closer and collected more premiums. But just to be safe, I want to go as far as possible because my purchase price or my average cost on this position is 151. So I don't want to be losing my shares at a strike much lower than my purchase price. So that's why I prefer to take a strike that's far from the current market price. And it's only 1 week away anyways. In my RESP, I'm going to keep Dell. Only reason is because I don't have enough capital to do a covered call trade on the big ETFs. And I guess I do have enough capital to do a covered call on one of these positions, probably Coca-Cola. But the problem with Coca-Cola is that it doesn't normally, when VIX is not high, when the volatility is not high, it doesn't have high premiums. So I don't think Coca-Cola I'll be able to sustain in terms of writing covered calls on Coca-Cola. And Dell is a company that I like a lot. But it doesn't have enough history or track record on the market though. It's been around for a long time, but it's been trading on the market for a short period, so it doesn't have that much history. But I do believe in the product, in the service, and the customer service. The revenues are growing year after year. They just made a profit last year, so I'm proud to hold Dell, and I think I got in at a good price at around $40, and I'm selling covered calls on it as long as I can. And then with the rest of my money in the RESP account, I'm just gonna buy not partial shares, but I'm not gonna be able to buy 100 shares of these stocks here, of course, but I'm gonna be buying shares of McDonald's, probably MasterCard. So any stocks on this list here that pay dividends though. So maybe JP Morgan, MasterCard, McDonald's. I really like McDonald's, so I'm probably gonna buy McDonald's with any leftovers. So I only have $105 here right now, but if I sell Bombardier, I can probably use that money to buy maybe some more. I'll probably buy some more MasterCard or McDonald's. And there was something else I wanted to buy. Oh yeah, I also wanted to buy CIBC stock, so the Canadian bank, because it has a very high dividend right now. It's got a 8% dividend yield. It's got potential for capital appreciation, of course, and it has good dividend growth. So that 8% year after year will become higher. And since the RESP is a long-term investment, at least 15 years, so it is something I can build for the future. I have time with this account. So in my registered account, so TFSA, RRSP, RESP, it'll be covered calls on ETFs and quality stocks only, the ones I mentioned, and a bit of dividend stocks in my RESP or RRSP. On any leftover money, it'll be just dividend stocks, quality dividend stocks. I think on the Canadian market, I personally would only touch Canadian banks. They have great yields and great dividend growth as well year after year. And on the American market, personally, I'm only touching these stocks here. And the ones with the best yield, if I sort it by yield, we've got JP Morgan, Coca-Cola, McDonald's, American Express. So if you notice in my margin account, I actually have 100 shares of American Express. So this was a strategy that I just tried recently. If you saw my video on dividend capture by holding the stock for only 1 day. So this is a strategy where I just wanted to capture the dividend, which was the ex-dividend date was Thursday. So that means I needed to buy the stock on Wednesday. So I bought the stock on Wednesday while it was trading at 79, as you could see here. But because I sold a covered call on it, my cost basis was about 75.6. So I only paid 75.6. And if I look at executed and look at American Express, you could see that I only paid 75.6 to get into American Express while it was trading at 79. That's because I sold a covered call against it right away. But then after ex-dividend, the stock dropped, which it made sense. But the stock dropped even more because just the general market dropped. So the stock ended up trading at 73, way below my net cost of 75.6. So what I did is I sold another call option for the following week at a 75 strike, collecting $2. So what this means is if American Express is trading above 75 come April 9th, I get my money back on American Express, and my total profit on American Express will be, so basically I'm going to be selling my shares at 75, but I paid 75.6 for it, but I collected $2 plus 40 cents of dividends. So I collected $2.40. So basically my profit on American Express, if it is trading at 75 come April 9th, will be $2.40 minus 60 cents. So about $1.80, so $180. It was definitely not worth the stress, but this is a trade that went bad. My intention was just to keep it for a day, just to get the dividend and get out, but it went against me. But at least with covered calls, I'm able to make this trade not as bad as it could have been. And then for the rest of my margin account, I'm just going to continue selling put spreads on the SPY, but I'm going to stick to selling on Monday, Wednesday, and Friday, 30 days out, with some management in case the trade goes against me. If the put spread gets tested, if the short strike gets tested, I'm going to start selling call spreads at the same expiration with the same spread width. And I'll stick to Monday, Wednesday, Friday, and I'll make sure not to increase my size. I was doing 3 contracts before I went back to 1 contract. And also, I'll continue doing the same day credit spreads on the SPY. They have been profitable for me. The only problem is the commissions really with Questrade. I mean, there's $5 in, $5 out. It becomes $10 while I'm only making a $50 profit. So it eats up a lot of the profit. So you can see this here was the same day expiration on the SPY. So collected $50, closed it for $20 on the same day. So from 9:30 to 10:30, one hour in, I made $30. But of course, after commissions, it's not that much. But what's great about this is I could do 10 contracts. So instead of making $30, it would have been $300 in 1 hour with a pretty good chance of winning. I had a 235 strike while the SPY was trading in the 250s. And there's another one here, April 1st. April 1st was an iron condor, as you can see here. So I opened it separately. So I collected about $113. And I closed the trade for $56. So the profit is the difference. Once again, it was only 1 contract. So after commissions, it's not that much. But if I had done 10 contracts, my profit would have been $500 in just 1 day. Actually, I think it was from 9:30 to 11:39. So about 2 hours. So I'm going to continue doing same day credit spreads on the SPY. Same day expiration credit spreads on the SPY. Especially because VIX is high. This is very doable because VIX is high. Once VIX drops, this might not be doable. All right, let me know what you think about selling your positions at a loss to buy other positions that have dropped as well, but at least they're better quality stocks. Leave them in the comment section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.